In the first week of January alone, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses for delivery. That single week wiped out roughly 26% of the exchange's registered inventory. That's not speculation. That's not hype. That's the official data. And while everyone focuses on daily price movements, something far more important is happening beneath the surface that could reshape the entire precious metals market. If you want to stay ahead of these market-moving developments, hit that subscribe button right now. The institutional players certainly aren't waiting, and neither should you. Silver is currently trading at approximately $82.49 per ounce as of this morning, up about $50 compared with this same time last year. That's around $30 cheaper than it was in late January after it broke the $100 per ounce record, but still more than double what it was a year ago. The metal hit approximately $111.36 per ounce in late January 2026, representing roughly 270% gains from January 2025 levels. Now here's why this pullback matters to you. Silver prices tend to be more volatile than gold prices, which is one of the key differences between the two metals that investors need to understand. But this volatility is creating an extraordinary setup. Based on current inventory levels of 103 million ounces registered against 429 million ounces of open interest, delivery stress appears probable if 25% or more of contracts demand physical settlement. Let me break down what's actually happening at the COMEX. Total COMEX silver inventory sits around 440 million ounces, but only about 124 million ounces are registered. That means less than 30% of the reported silver can actually be delivered. The mounting pressure on COMEX silver delivery systems has created unprecedented market conditions, where physical inventory constraints threaten the stability of paper contract settlement mechanisms. During the first week of January 2026, COMEX warehouses experienced that massive 33.45 million ounce withdrawal. On January 7th, data revealed JP Morgan issuing 99% of 8.1 million ounces in delivery notices through 1,624 contracts. When a single institution controls that much of the delivery mechanism, you're looking at a fragile system. The March 2026 futures contract alone represents 528 million ounces of exposure against only 113 million ounces of registered silver. That's more than 4 times the deliverable supply concentrated in a single contract month. The math here doesn't work, and sophisticated market participants know it. Gold provides important context. Gold was valued at $5,072 per ounce as of February 11th, 2026, marking a $24 uptick from yesterday and more than a $2,168 gain over the past year. Central bank demand remains strong, with the People's Bank of China extending its gold purchases for the 15th consecutive month in January. This institutional accumulation in gold is mirrored in silver. On January 20th, 2026, Sprott Physical Silver Trust announced it had updated its at-the-market equity program to issue up to $2.0 billion of units, doubled from the $1 billion announced in December 2025. Proceeds will fund physical silver bullion acquisition. Sprott is effectively signaling that institutional demand for allocated physical silver justifies this scale of capital deployment. Now let's talk about what major analysts are actually predicting. TD Securities has an average annual price target for silver at $65.50 per ounce, with a 2026 high of $118 per ounce. In January, Citigroup revised its silver price forecast higher, expecting silver prices to reach a record $150 per ounce within 3 months. JP Morgan Global Research projects silver prices averaging $81 per ounce in 2026, with a high of $85 per ounce in Q4. Many analysts now see a path to triple-digit silver, especially after the metal surged 147% in 2025. Gold Silver's lead analyst Alan Hibbard expects silver to trade above $100 in 2026 as supply deficits deepen and industrial demand accelerates. The international picture adds another dimension. International price spread analysis indicates growing disconnection between Chinese and American silver markets. The Shanghai Futures Exchange silver contract trades at premiums exceeding $3 to $5 per ounce compared to COMEX futures. This divergence reflects China's refined silver export restrictions and accelerating domestic industrial consumption. China's reclassification of silver as a strategic material and restriction of exports has fragmented the global market and exacerbated supply shortages. When the world's largest industrial consumer of silver restricts exports, that's not a bearish signal for prices. But let me give you the balanced view, because you deserve to understand the risks. As one expert noted, if industrial demand slows and real yields rise again, silver could either stabilize or retreat from current price levels. A bearish scenario remains possible if the US dollar strengthens or investors shift their focus to high-yield assets, causing silver prices to drop to the $60 to $70 per ounce range. Some analysts maintain there is a 0% chance of a COMEX default. They argue the exchange has mechanisms to settle contracts in cash if necessary. That's technically true, but cash settlement at a time of physical scarcity fundamentally changes price discovery. The cryptocurrency correlation deserves attention. Bitcoin is currently trading around 65,185, down significantly from its all-time high of $126,080. Stephen McClurg, CEO of Canary Capital, told CNBC he expects Bitcoin to fall as low as $50,000 in the summer. Precious metals continue to be volatile too, with silver and gold experiencing pressure alongside crypto. This correlation matters because when Bitcoin stabilizes or rallies, it often provides a tailwind for risk assets, including silver. From a technical perspective, support levels at $69 to $70 and resistance at $80 to $84 serve as important references for investors, with the potential for a breakout to $85 to $90 under optimal market conditions. Here's my analysis. The structural forces driving silver are fundamentally different from previous cycles. Silver prices surged above $90 per ounce in early 2026 due to a confluence of four structural forces: a physical run on paper silver, China's export controls, increased central bank accumulation, and rising demand from nuclear power for AI and clean energy. Industrial uses like solar, EVs, electronics, and AI hardware now make up over half of global silver demand. Solar alone is projected to consume more silver each year, pushing demand to new highs through the 2030s. This industrial consumption creates a floor under prices that didn't exist in previous silver cycles. I assign roughly a 60% probability to silver retesting and eventually exceeding its January highs by mid-year, with a 25% chance of an accelerated squeeze if March deliveries stress the system, and a 15% chance of extended consolidation in the $70 to $85 range. For those considering positions, here's what I'd watch. The $69 to $70 zone represents critical support. A sustained break below that level would suggest further downside towards $60. On the upside, reclaiming $85 with strong volume could signal the resumption of the uptrend. Markets have since priced in a higher probability of 3 Fed rate cuts this year, up from 2 just a week ago. Investors are now watching upcoming U.S. jobs and inflation reports for further clues. The January CPI data could be the near-term catalyst that breaks silver out of its current range. The downside risks are real. Historical precedents from the Hunt brothers crisis and recent LME nickel suspension suggest dramatic price movements if physical scarcity drives premium expansion. Default scenarios could push silver prices significantly higher as alternative sourcing costs and panic buying create extreme volatility. But volatility cuts both ways, and rapid moves down are equally possible in the short term. Now, I want to hear from you. Are you positioned for the March delivery period, or are you waiting on the sidelines? Drop your thoughts in the comments. Do you think the COMEX can handle delivery demands, or are we heading towards something unprecedented? Your perspective matters, and I read every comment. Many experts anticipate that silver will eventually march toward $200 per ounce. Whether that happens in 2026 or over a longer time frame depends on factors we're tracking daily: inventory levels, delivery rates, institutional flows, and monetary policy. The price of silver is widely expected to increase in 2026, according to precious metals investing experts. If this analysis helped you see beyond the daily noise, subscribe and hit the bell so you don't miss the next update. The March delivery period is approaching rapidly, and the data is going to move fast. I'll be here breaking it down for you. As always, this content is for educational purposes only and does not constitute financial advice. Do your own research, understand your risk tolerance, and consult with qualified professionals before making investment decisions. Markets can move against you, and past performance never guarantees future results. Stay sharp out there.